Hi guys, as soon as we get our salary, we tend to spend the maximum on living expenses, EMIs, credit card bills and other expenses. We don't think much about the future. But with the current market conditions, layoffs, inflation and other factors, thinking about the future has become very important. The situation is not like it was before. The speed at which AI is advancing, it feels like no one's job is safe and we can't solely depend on our salaried income anymore. If we don't create other sources of income, it'll be very difficult to survive in tough situations in the future. And if you're new here, I'm Sai Mocharla, currently based in Ireland. I currently work as a senior product manager at MasterCard with over 10 years of experience in the corporate world. And I have worked with companies like Google, Amazon, Apple, IBM, and some innovative startups too. My channel focuses on careers and finance topics, giving you practical tips to help you succeed. And if these topics interest you, please subscribe to my channel. Now back to the topic. Firstly, when you get your salary, I suggest following the 50-30-20 rule. Now 50% on needs like basic expenses like rent, bills, EMIs, transport or accommodation, etc. And 30% on wants like dining out, going to movies or traveling, and 20% on savings. Personally, I try to save 40 to 50% to get better returns in the long run, but it's up to you. And when I say savings, I don't mean just keeping money in a savings account. If you leave your salary in a savings account, that is the worst thing to do, guys, as your savings will depreciate quite quickly. And before I dive into this topic, please consider this for educational purposes only and consult your financial advisor before investing. Now, keeping your money in FDs or other saving interests just matches inflation, so it doesn't grow much. And if you leave it in a savings account, you're wasting your hard-earned money. I personally invest for the long term, and the main assets I invest are stock investing, mutual funds, derivative trading, and US equity investing. Now let's see the returns I have received from each asset type so far. From stocks, I got about 14% this year. From mutual funds, around 13%. From derivative trading, around 16%. And from US equity, I almost doubled the amount I invested back in 2022, which is for 2 years time period. Now, the above returns are the profits I have made until now in 2024. And let me break down my returns in a way that's closer to what actually happened. So I invested in stocks and they grew by 14%. But here's the interesting part. I took 4 lakhs worth of those stocks and used them as collateral for options trading. Now this strategy is called leveraging, and this allowed me to make an additional 16% on that 4 lakhs. So that 4 lakhs of stocks, I actually made 14% from stock growth and 16% from derivatives, which makes it a total 30% total return. And my mutual funds grew separately by 13%. And this is how you can leverage your investments in the market to boost your returns. But also remember, it increases your risk. It's not for beginners, and you should do this only if you really understand what you're trying to do. And if you're just starting your investment journey, I would suggest starting with mutual fund investments. When we start investing, we have a lot of questions and a lot of expectations. And starting with mutual funds can provide foundational knowledge while you develop skills for stock picking. Now, mutual funds also come in many types and different asset classes. Now, each mutual fund invests in different industries and stocks, generating various returns, and has different performance metrics and CAGR as well. Knowing these stats one by one will slowly build your knowledge about equities and the overall market. And you don't have to put in all your savings into the funds. Instead, you can do systematic investment plan, which is also called SIP, which is a nice way to start getting into the habit of investing. It lets you invest small amounts regularly, like every month, instead of putting in a large sum all at once, which I don't recommend as well. And this makes investing more affordable and helps you build a habit of regular saving as well. And another reason why I like SIPs are they use a strategy called rupee cost averaging. This means you buy more units when prices are low and fewer when prices are high. Over time, this can potentially boost your returns and reduce the impact of market ups and downs. That's why I always suggest beginners start with mutual funds, and I've made a detailed video about mutual funds. I'll link it above. And please check that video for more information on mutual funds. But at a high level, there are mainly 4 types of mutual funds. Number 1, equity funds. These funds are like owning little pieces of different companies. They invest your money in stocks, which can grow quite a lot in value over time. This means you could earn a decent amount of money, but there's also a chance you could lose some if the stock market goes down. But if you're picking these funds, be prepared to see sudden dips in your returns, but not to worry. They will eventually grow over time. Ups and downs are very common, especially in the stock market, so keep this in mind. And in India, we have a unique type of mutual fund called Equity Linked Savings Scheme or ELSS. It's special because it not only invests in stocks but also gives you tax benefits under Section 80C. You can save up to 1.5 lakhs in taxes per year with ELSS, making it a popular choice for many investors looking to grow their money while reducing their tax burden. Now, number two, debt funds. These are more like lending money to companies or the government. They invest in bonds, which are like IOUs that promise to pay back your money with interest. Debt funds are generally safer than equity funds, but they don't usually grow that much compared to equity. It's like putting your money in a safe. It might not grow a ton, but it's less likely to disappear. Now, number three, hybrid funds. These are a mix of both equity and debt investments, and they try to give you some of the growth potential of stocks while still offering the stability of bonds. It's like having a bit of both growth and stability in one. And if you want to take a conservative approach in your investment journey, you can go with these hybrid mutual funds. Number four, index funds. Finally, talking about the index funds, they try to match the performance of a specific index like the Nifty 50 or Bank Nifty by investing in the same companies that are included in the index. This makes them a simple and low cost way to invest in the stock market. You might have this question now. Why can't I just buy index ETFs? So index funds are suitable for long-term passive investors seeking low-cost diversification. On the other hand, ETFs offer flexibility and intraday trading for active investors but come with brokerage fees. So if you want to invest for long-term, you can go with index funds, or if you're investing for short-term, only then pick ETFs. Also, an interesting fact about index funds, the total money managed by these funds, also known as assets under management or AUM, grew by over 500% between 2019 and 2023. Now, this shows that more and more Indians are choosing passive investing strategies. And also an interesting fact, also India has a unique advantage called demographic dividend. This means we have a large young population entering into the workforce, and as these young people start earning and investing, it could drive economic growth and create great long-term investment opportunities in our country for everyone. And in a nutshell, that's about mutual funds. Now let's talk about a few things to keep in mind when you're picking a mutual fund. Few things that you have to look at are: number one, past performance. While past performance doesn't guarantee future results, it can give you an idea of how well a fund has performed under different market conditions. Now you can look for consistent performance over a longer period rather than just focusing on recent returns. Number two, expense ratio. This is the annual fee you pay to the fund house for managing your investment, and lower expense ratios can make a significant difference in your returns in the long run. Number three, asset under management. Now this is the total value of the assets managed by the fund. While a larger AUM doesn't guarantee better performance, it can indicate that the fund's popularity and confidence in the fund by investors. Now number four, exit load. This is the fee you might have to pay if you withdraw your investment before a certain time period. For example, a fund might charge you 1% exit load if you withdraw your investment within 1 year. Similarly, another fund might charge you for withdrawing in 3 years' time. It is good to consider the exit load before investing, especially if you need to access your money in the short term. Now, I'd like to hear about your investment experiences or any questions you might have. Share them in the comments below. Your insights could help others, and your questions might inspire my next video too. See you in the next one.